Say anything. I think I've left it on yellow. So, tell me, can you hear me? Hello. I'm coming to you from the studio here in Melbourne. You can see it all around me. I added these vines the other day just so it looks a little bit more professional, I guess. We're here on Flinders Lane in Melbourne, and it's a lovely night here in Melbourne. So I'm going to get out afterwards and head down to an investing event of all things. G'day, Chris. G'day, good evening. They both mean the same thing, don't they? How are you going? So tonight we're going to be talking about bank shares, but we're also going to be talking about short selling. I had a great question that come through via Twitter about how short selling works. And I'll explain it while also sharing some of my thoughts around it. I speak to a lot of professional investors who have used short selling either as part of their overall strategy or in a small part to protect their portfolio. And I'll give you my 2 cents on what I've found, having seen it up close for many years. There it is. Jonesy, you've said it. G'day, Owen. How about a quick dive into shorting? Guess what, mate? I knew you'd be asking because you did ask via Twitter. So I've incorporated it into tonight's slide. So we'll get to that in just a moment. G'day, Jeremy. On time. No lives to save tonight, mate. No, nothing like that. Rob's joining us. There we go. There he is. He's saying g'day in the chat. And don't worry, mate. You're not too late. JJ just said, hi, Owen. Found your podcast with Luke Larrative on lithium. Very interesting. Well, JJ, if you like the podcast, I'm sure Luke would be happy to join us on Selfwealth Live and have a chat about everything to do with lithium. It was a really interesting conversation, that one. I didn't really think it would go that way, but we ended up spending, as you know, about 40 minutes just talking about lithium companies. So, yeah. Okay, so, yeah, it's I think what we're going to have tonight is when we do the top 5 most bought and the top 5 most sold, I think we're going to have a lot of winners. I don't want to give too much away, but I was doing the list and I was thinking, geez, the guys are going to get this one. So Eve, g'day. Hello, Eve. Welcome. I'm glad you enjoy the sessions because I enjoy doing them, and so does Rob. So, yeah, let's get into it then. I've dilly-dallied enough. I've got a bit of a tongue-in-cheek joke. Jeremy, I think you gave me, I can't remember what your score for my joke was last time. I don't think it was great. And then I think it was Jake said something to me on Twitter and gave me a 5 out of 10 for a joke a few weeks ago. So hopefully I can improve on that. I asked around the office today, said, guys, do you have any jokes for me? Selfwealth Live tonight, do you have any jokes? So here's the joke, right? Bit tongue-in-cheek, all right? Kate didn't really like it. My colleague Kate didn't really like it. What's the difference between a pigeon and a stockbroker? It's meant to say a pigeon can still make a deposit on a BMW, not a stockbroker. So this is meant to say a pigeon. The joke's on me here. A pigeon can still make a deposit on a BMW. And naturally, I sourced these images from Google. You can tell by how high quality this image is. The pigeon is very, very proud. So how did I do? Give me a score out of 10. Coming up on Selfwealth Live next week, we've got Nathan Bell. I'm really excited to have Nathan on the show. A pigeon has a brain. Thanks, Stu. When Owen is the joke. Yes, Rob. Exactly. So next week on Selfwealth Live, we've got Nathan. Nathan's one of, I would say, Australia's best investors, to be honest, and he's one of the best educators around that. So it's going to be our pleasure to have him on the show. I've asked him to bring 2 companies to the table, so he'll be bringing 2 ideas for us all next week, which would be great. Rob's giving me a 5. Nifty Nev's giving me Nev. You give me a 2. Come on, that was one of my best. That's some of my best material. Mike, thank you for a 10 out of 10. Jason, 3. Peter, say I'll tell all my friends. Oh, great. Well, wonderful. So Dr. Lyndon Walker over on LinkedIn, thanks for saying that you love it. I appreciate it, and thanks for tuning in. I really appreciate that. My partner just said it's a 3, says John. Oh no, the whole family's voting now. So okay, I better move on. So next week we've got Nathan Bell. Hopefully we'll have a few more great guests before the end of the year. If you do want me to have someone on the show, if you do want Rob and I to go out there and hustle and get some great speakers, we're very fortunate that we can. We just need your ideas. You just need to tell us. I've still got a whole list of names to get through, but if you do have someone, let us know. John, thank you for clarifying. She doesn't get financed Or jokes. Well, you never know. You never know. Okay, so just a quick nudge here. You will have noticed inside the Selfwealth platform at the top here that the team is encouraging everyone to get the two-factor authentication. Basically, what that means is your account is going to be safer if you put that lock on it. Basically, what it is, every time I log into the work computer here at the office, I have to do it as well. It sends a notification to my phone. Obviously, this is a bit of a different situation, but it's the same type of thing. You need two different points of failure, basically. And so that's just making it much safer for you. It doesn't necessarily change the Selfwealth platform. It just makes the access more secure because it turns out, we talk about all these cybersecurity companies. It turns out that the most vulnerable spot in any enterprise network is actually the user. It's sad to say, but it's actually the human that tends to use the same passwords or whatever. I think now more than ever, this is more important. So be sure to check that out and get that activated if you haven't already. And if you haven't already, please subscribe. We'll be very, very, very sad. We've crushed the 7,000 target that Rob and I had. Now it's onwards to 8,000. So the more people that can find this and invest sensibly for the long term, the better we'll all be. Especially over Christmas, where there's a lot of new year, new me type investors. So tell them to send them over our way. Okay, so I just want to maybe take a few moments just to explain what short selling is, and maybe just before I get to the screen, I'll just say, short selling. My opinion on short selling is quite a different opinion. I've seen short selling from many different sides of the table. So I've seen short selling from an investor's perspective, as in you or I doing it. I've seen it from professional investors who run hedge funds. I've seen it from professional investors who just add it on as the side piece to what they're mainly doing. Just even yesterday, I was here in Melbourne speaking to one of the world's biggest fund managers, and that one of their best and biggest ETFs in the United States is actually a fund that has a portfolio that invests, and then they do options over the top. That's one way that you can protect a portfolio or increase income. This kid is depressing, like this year on the ASX, Jason. Yeah, that's right. So it's really emotive, trying to get everyone to subscribe. I know you have already, but so I've seen short selling from all different parts of the spectrum. There are short sellers who, like John Hempton here in Australia. John Hempton is one of the short sellers, one of the most famous short sellers, not just here in Australia, but around the world. And his principal strategy is short selling. So that's basically what he does. Then there are other people, like I said, that just do it as a small position and so on and so forth. But I'll walk you through exactly what it is, because Jonesy, I know you had a good question on this. Let's bring it up here. So let's just look at this flow chart. And I guess what we can do is I'll get my head out of the way if I can do that. Let's see if I can just turn me off for a have I lost myself? There we go. I need to be on the screen. It turns out that I need to be on the screen to do this. So apologies. So when we look at, and here we go, Mac take again. I'm pretty good with this whole tech thing. We're back. Okay, so here we go. We can see that this investor here that has a stock. It could be Tesla. It could be CBA. It could be even an ETF. They have some type of investment that they own, right? And so here, what we can see is they're lending the shares out. So let's say you have a share of Commonwealth Bank and you can lend that out. You lend it, and for every $10, let's say you have a $10 share, you get 50 cents, right? So this person here, who is the short seller, takes that share and then they sell it because you know it's worth $10. So they sell it at $10, pocketing themselves $10. It falls in value down here. Go back. It falls in value to $2. And so the investor has to buy back the shares. So they buy back the shares at $2 that they sold at 10. Then they pass you the $2 stock back and the 50 cents that they owe you for lending it. It's kind of like an interest payment. Now you're thinking, okay, I had it at $10 and now I've got it at $2. The key thing here is that if you lend your stock out to be shorted, you have to expect that you're going to keep holding it. And so you have to hold it throughout this process, right? And so here you can see the person saying, this would be you. You could say, I would have lost my money anyway. My share would have fallen from $10 to $2. But hey, I got 50 cents from the short seller while it was on the way down. So it could have been worse. I got my 50 cents. That was like the interest. And I got my $2 stock back. So for you here, as the person who owned the shares, there's really no difference. You just held the shares like you would anyway. And someone said that they'll give you 50 cents and I'll give you your stock back in, say, 30 days. And so the net outcome from this is that you've got $2.50 of value. And then the person who took it from you sold it at $10. So imagine a $10 note, they sold the shares, and then they got $2 back when they had to outlay $2 when they bought it back. But they also gave you 50 cents. So the short seller in this case, and I'll bring up my thing, the short seller gets this here. I'll get rid of the middle bit, make it transparent. The short seller is in this box here. So you can see the GIF 1000, you said that's a crap deal. Yeah, so here you can see that the short sellers actually made $7.50, but they actually didn't have anything to begin with. They actually didn't own the shares. They just made $7.50. And the investor on the side here, they still lost money. But for the short seller, it worked out. Now, g'day Raptor, welcome. You just missed my audio fiasco, so you're in perfect timing. Now let's have a look at it and see if it goes the other way. So here, it's the same deal. The investor, as in you up here, you say my shares are available if anyone wants them. And so you get 50 cents from the short seller who sells it at $10. But instead of falling all the way down here, I want you to imagine that the stock goes all the way up here, right up to the top corner. In this case, the short seller, and I'll bring my little thing up again. In this case, the short seller actually loses because what happens here is they've sold for $10, but then they've promised to give you the shares back. And so this should be a $20 stock. So they've promised to give you back your shares. And what's happened is it's gone against them. So the shares, if we get rid of this, has gone up to $20, which they have to repurchase and then give that back to you plus the 50 cents. So you get 50 cents of income, but you also get your $20 stock back. So you've doubled your original investment, plus they've given you 50 cents. But for the short seller, they've lost $10.50 for doing basically nothing. So they've basically lost everything here. And so if we go to the next slide, this is where shorting becomes risky. In short selling, the reason that it can become risky is that you can lose more than your original investment, but you can never make more than 100%. So that's what makes it risky. Where if it was investing like in ordinary shares where you buy and hold, you would be this green line and your downside would be limited to the red line. So this is the old cliche in investing that if you're a long-term investor, you can only lose 100% of your investment, but you can make a lot more than 100%. Well, short selling is the opposite, and that's what makes it risky. Now, there are multiple ways to short sell. What I've described to you just then is the true version of short selling, but there are other ways you can do it. For example, you can use trading instruments like options contracts, or you can use CFDs. I think they're incredibly dangerous. And this mechanism is very well established. So I'll give you an example. In Australia, the biggest ETF is the Vanguard VAS ETF, which you all know. And what happens is, because Vanguard has so many shares that it holds for its investors, billions and trillions of dollars around the world, what it can do is it can make some of its shares available to short sellers. So it identifies really reputable short sellers and says, hey, you can borrow this, give us some interest, that little 50 cents that I talked about, give us some interest, and I know you're good for it, so it's fine. You go and do your thing, you go and do your trading or whatever, Mr. Hedge Fund, and come back with the shares in 30 days or 100 days or something like that. What Vanguard actually does when it does that is all of the profits that are made on the short selling that it loans out. So it doesn't actually do the short selling itself. It just makes money on the interest. If you think about it like that, it actually puts that back into lowering the fees. So when you see that the Vanguard VAS ETF has 0.1% in fees, it actually is probably lower than that. It's just that that's the official fee number. It's actually probably lower than that because they're using the income that they generate from the short selling positions to bring your fees down. So that's why it tends to work in their favor, and it can be done pretty safely for them. So I see some questions have come in. Eve, they say options traders are individuals who stoop to collect pennies on a railway track, i.e. there's little reward and can be hit by an oncoming train. Yeah, the old picking up pennies in front of a steamroller, Eve. So that can be true. Some options strategies are good and reasonable. They're not really that risky, but they're not for people that are not for professionals. That's why it's very rare that brokerage providers in Australia offer that type of functionality to trade options. But if they do, you typically have to fill in a form. Some of them would even make you do a test because it can go wrong pretty quick. Is shorting a self-wealth feature, Jason? As Rob said, there are some ETFs that specialize in it. So in Australia, there are some ETFs that go in the opposite direction, because I should have started with this. The reason that people short sell is they believe something's going to go down. Now, there is a belief that short selling is evil because you're betting against a company. But the actual act of short selling has no impact on a company. It actually has none whatsoever. It's like if you buy shares in BHP expecting it to go up. Just by buying it, it doesn't mean that you're supporting it. It just means that you own part of the company. It's the same with short selling. You just think it's going to go down. But it's made to sound evil because of, you're betting against a company and all the people that work there. But that's not how it works. Sure, they might stoop to levels where they try and manipulate the market, and that's not good. But the actual act of short selling doesn't make a lot of sense. We don't have to get into that tonight, Eve, but happy to answer that question in another Self-Wealth Live. But you can sell covered calls. So there are plenty of ETFs that do that here in Australia. So that's an investing strategy where you own shares, but you also use derivative contracts to make more income. I hope that explains what short selling is. If you just need to remember, there's just a few movements that go on. You lend your shares out, typically to a big fund manager. That fund manager or hedge fund manager can go and sell those shares, and they take all the risk. If the shares fall, they win. If the shares go up, they lose. But you as the end investor should still get your money, provided that the hedge fund is reliable and will pay its bills when it falls due. Now, there are many other ways to do it. Like I mentioned, different types of strategies, but that's the purest form of short selling. And not many brokers offer that type of functionality because it is very risky. It's typically for professional investors. Jonesy, you said, is the share borrowing for a fixed time, or can the shares be returned at any time? It's a great question, Jonesy. So it can be both. There are certain ways, like if you used options, for example, that can be, they'll have rolling maturity dates. If you are doing traditional shorting, it can be over the counter, meaning that it can be negotiated between institutions. And there's also a thing, Jonesy, that happens with short selling is that the value of the income that you receive from having your shares available, so say in my example, the 50 cents, the value that you receive for allowing your shares to be held short is actually dependent upon how in demand your share is. So if a lot of short sellers want that share to sell short, then your position is going to be worth more and you're going to get more income and there'll be more offers available. But sometimes there isn't, and your shares just sit there forever and no one ever sells them short. So I hope that makes sense. Epicris, how can you tell if a stock is heavily shorted? In Australia, it has to be reported to ASIC. So ASIC, ASIC, on their website, you'll find information there. And some of the data providers offer it as well. But borrowers can be very expensive sometimes, which hinders selling. Yep, exactly, Pima. So you just beat me to it. Is this what happens in The Big Short? He bet against the price of mortgage bonds. Exactly what happened, Gene. And you can see why in the movie The Big Short, Michael Burry and all the others were so stressed out, because even though they were right, even though the thing was basically a Ponzi scheme, the property market in the United States, even though they knew for sure it should fall, the thing kept going up. And they had to keep what we call covering. They had to keep stumping up more and more money to say, yes, I'm fine, I can afford this. Yes, I'm fine, I can afford this. Yes, I'm fine, I can afford this. And that's what almost all of them went bust before the property market collapsed. So that's basically what happens. So as Mike said, Mike nailed it. He said here in the chat, he says, timing is critical. Benny, hey all, didn't realize it was already 6:23 p.m. or Wednesday. It's been a long week. Yeah, it has been a long week. The Big Short's a bit of fun. That entire movie, I think, is great. Expensive margin calls. Great movie. Yeah, Jason, great movie. The Big Short is probably my favorite finance movie, to be honest, because they use really simple language to explain something that is incredibly complex. So tonight's show, the main thrust of tonight's show is actually going to be about bank shares. And trust me, it's not going to be that boring, and I'm going to answer your questions as we go. But I did want to, you may remember last week we had Kerry Craig on Selfwealth Live, and he was brilliant. We had some really, really, really good feedback from Kerry's session. So if you haven't already checked this out, I'll chuck it in the chat now. But in that, Kerry talked about basically that the stock market tends to rebound before the economy crashes. And that's not like, it doesn't happen all the time, but it's a general truism of what's happened in the past. And the reason that's important, in the way it ties into what I was going to talk about tonight, are the ETFs and the stocks that I've got on my watch list. So when it does bounce back eventually, these are the types of companies that I'm looking for, but maybe next week or the week after. Tonight, the reason why we ended up going with the bank shares is because National Australia Bank reported its results today. You can see that shares fell 0.91%. This follows Westpac and Macquarie, who also released their results. And in the next, say, 20 minutes, I'm going to just quickly go through those results, but also show you how to value a bank share. And you'll be surprised at how easy it is. Banks themselves are incredibly complicated. Some of these reports, look at this, it's 268 pages. Now, many of these bank reports, this one's 314, this one's 308, and this is only one of about 10 different documents that come out every 6 months. So, I mean, I'm a very slow reader. It would take me 6 months to get through all 10 of them, particularly with how boring they are. So what tends to happen is when we do valuations for a company, like let's say we're talking about, I don't know, like the Bull Bar company, you might remember ARB Corporation, it does bull bars and 4x4 accessories. When we look at a company like this, it's pretty straightforward. It's basically, if you think about it, it's basically how many bull bars do you sell? How much do you sell them for? And that's basically how you figure out the business. Then you would know the costs, because obviously the costs are, they impact the business performance. But for a bank, what happens is you quickly get into serious complexity really quickly, because there becomes a heap of different assumptions that go into how the bank operates. Some of these banks have tens of thousands of employees. They have a technology team that might have 1,000 software engineers. And so they might have more software engineers than ARB has in all of its employees. So when things get really complicated like this, it's important that you bring it back to absolute basics. And so I will be explaining to you how you do that. But first, I think if we look at bank shares overall, like we say, look at Commonwealth Bank 10 years. The share price, this is obviously since a bit of volatility in 2011, 2012. So the share price has gone up. But now if we look at, say, Westpac, which was the second biggest one, you can see it's kind of gone nowhere. National Australia Bank, if we bring this up here, National Australia Bank's done about the same. If we look at ANZ, done about the same. But if we look at Macquarie, obviously it's done a lot better, and I'll explain why it's done a lot better in just a moment. So if we look at these banks, we think, well, to be honest, they're kind of underwhelming over the last 10 years. This is not including dividends and franking credits. So I'm not missing out on that. I'll explain why they're important in just a little while. But if we wanted to understand why banks have performed well in the sense of paying dividends, but poorly in the sense of their share prices, the next 2 or 3 slides will explain that. So here we can see property prices, and this is from 2011, and they just set the index at 100. This is from the ABS. And you can see property prices across the country, with the exception of probably Darwin, poor old Darwin there. And, with the exception of Darwin, for the most part, they've been pretty strong. And there's obviously would have been rental income there as well. And so obviously as property prices go up, that's pretty good for banks because it means that their loans get bigger, which is why the loan size and the number of loans on the balance sheet of these big banks has increased. We can see here, this here is deposits and other borrowing. So it's on the asset side. Where am I looking at? Loans here for Westpac. You can see that here. They've continually gone up. And one of the reasons that they keep going up is because property prices are increasing and people are getting bigger loans. It's not necessarily because they're doing anything that special. It's just more people, bigger loans. And that's basically it. But if there's something peculiar has happened, if you look at how the banks have performed on a profitability basis, they've actually got worse. And so this chart actually goes back to 2005. And from about here on to the right, they're all the analyst forecasts. And so this is from the ticker terminal. And so you can see here, this chart, it's probably a bit crude for me to have bank profits at the top. But what it does is it compares bank profits to the shareholder equity that's in the business. So how much have shareholders contributed? And you can see for every dollar that shareholders own of the business, effectively, the bank has got less profitable. But it's important to understand that's per unit of shareholder dollars. Because the banks have grown, they're actually making bigger profits. They're just making it on a smaller profit margin. And so there are a few reasons for this. The first reason why banks have become less profitable but have become bigger is because interest rates have fallen. And as interest rates have fallen, their profit margins have been squeezed. Because if you think about it, if the interest rate that the RBA has set, or the central bank has set for our economy is 5%, and you go hunting for the best deal on your mortgage, there's a bit more fat in there. You can negotiate, or you can sometimes just cop a bit of a higher interest rate than, say, if it was 0%, because if it's 0%, everyone's going to be really close together in what they can offer their customers. And so as interest rates have fallen, the profitability of the banks have fallen because they haven't been able to kind of flex that muscle, if you like. And the other really important reason why banks haven't become as profitable over time, and this chart from Selfwealth shows you exactly why. I'll explain what it does in just a moment. I'll move this up out of the way there so we can see it. Now, what this chart actually shows you in the red line shows you how much money banks make, in this case CBA, I believe it's CBA, how much money CBA makes from lending to customers. That's the red line, lending, right? So this is them lending money to mortgages, to investors, to whoever. Now, the darker line here, which I'm not sure how I describe that color, but this darker gray looking line is actually the revenue or the income that the bank makes that's not related to lending. So this might be like financial planning advice. They used to sell some of the worst insurance in the industry. They, charge fees on certain things. And so that's that type of stuff. And you can see that that's fallen over time. And the reason why this has fallen is there are a few reasons. One, the banks have been told that they can't offer crappy advice anymore. So all of them have sold their advice arms, basically. They can't offer crappy insurance anymore. So they've sold all of their insurance. A lot of them have moved out of funds management, where you would invest in one of their funds. Like if they had an ETF or something like that. They don't do that. You notice that the banks don't do ETFs. And that's principally because they've all been told that they have to focus on lending because there was too much dominance, basically, and they were offering pretty poor products. And so that's effectively what has happened over the last few years. Banks have been lending more money to homeowners. They've been taking less from customers and fees. But because interest rates have fallen, they haven't been able to make as much profit per unit of lending. They've had to kind of lend more, but at a lower profit margin. And thanks to property prices going up, it looks good on their balance sheet. Crappy advice for a 3 to 5% yearly management fee. Yeah, so if you think about it, that's great, Michelle. If you think about it, Selfwealth charges $9.50, right, for a trade, which is incredibly low if you're trading $10,000 parcels or $20,000, even if you're trading $1,000. Some of these financial advisors back in the day would charge 5% just to invest. They would charge 5%, and that's before you got to the management fees. It's crazy, and some of these things still exist. Some people that have still invested from 10 or 20, 30 years ago have still got these arrangements in place with their financial advisors, and they don't even know. And that's the crazy thing, when you can go and get good quality advice a lot cheaper these days, and you can invest in ETFs and all kinds of stuff. It's incredible. One of the jokes that I was going to put in tonight, and it wasn't much of a joke, it was actually, Where Are the Customers' Yachts? It's actually a famous book, and it's kind of like a tongue-in-cheek joke that there are a bunch of brokers looking out across the harbor, and they're like, that's this broker's yacht, that's this broker's yacht, that's this stockbroker's yacht. And someone goes, but where are the customers' yachts? And it's because Wall Street and the investment banks got wealthy. So the banks here have basically made more money from lending. CBA in particular has been a standout here. And by the way, you can check on all of this. If you go, let's say for Westpac, you click on Westpac and you go to financials. If you scroll down, you can actually see that a bank primarily makes money out of interest income. We don't want interest income. What we want is net interest income. The reason is the net interest income takes let's say I pay, for example, $1,000 to my bank for my home loan every month. But then the bank has to pay out interest to term deposit holders. This is the interest to term deposit holders, and this is what I pay for my mortgage. So we need the net amount. And we can see non-interest income right here. And we can see this here, 10 out of 10, Jason. You would have given me a 10 out of 10 for that one. No, thanks, mate. And so you can see here that Westpac is much the same. It's actually probably had less success. Like, it's exited even more than CommBank has. If you think back to that slide before, like CommBank has still got some money making down below, but Westpac is just going in one direction. And it's the same if we look at, say, ANZ. Here, real quick. We'll go net interest income. ANZ had this disastrous strategy where they thought they would go overseas and they would try and expand into Asia, and it didn't really work. So we've just got net interest income here. I don't think we have non-interest income. There we go. This one right here. And so here we can see with ANZ's divestments and all that sort of stuff, how that changed the business model through time. And it's the same for NAB. In fact, NAB had a very bad experience from the GFC when they woke up with a hangover that lasted about 8 years from the UK. They went out in the UK and they basically didn't come home. Jeremy said, my first 5K when I was still a teen went to CBA. left with 3K, put me off investing for 15 years. And the bottom line was that wasn't investing. So didn't learn the crucials. Self-wealth for the win. There we go. I like it, Jeremy. Yeah, the old fund management fees were crazy. We put up with them for so long. Expand to Asia. So funny, Mike. Yeah, exactly. The good thing about it is if you run one of these companies, you can just expand somewhere and then take your pay packet and leave when it doesn't work out. So the key question then becomes, okay, well, maybe actually before I get to the valuation, let's just have a quick look at the results. Overall, the results were pretty positive for the banks, to be honest. If we go back to this chart about here, with interest rates falling, remember how I said that impacts the profitability of a bank? Well, now that interest rates are going back up, and mostly that was happening in the second half of their financial year, so only the last 6 months, what we're seeing is the banks are actually recording bigger profits. So if we look, where is it here? If we look, they've given us a summary. I don't want to have to go through all 268 pages. So if we look here, we can see that the profit of the business has gone up, 8.3% up over last year. So the profits have gone up, and that's actually led to a higher dividend. So the dividend has actually gone up because they've recorded more profits, and so on and so forth. And in fact, the NAB's dividend was up very slightly. It's half-year dividend. Obviously, they pay 2 dividends a year, the interim or half-year, and the full year. The same for CBA. But it's also a similar, not quite as impressive result from Westpac, but it's probably going to be more of the same. The thing that they both noted is that the key question now becomes what happens not this year, but next year when they're probably going to record losses. So you can see here, not as impressive from Westpac overall, but still the business is moving. It tends to be moving in the right direction. Now, the key thing to keep in mind, if we come down here, the key thing to keep in mind is what I explained, I think it was last week when we talked about ANZ's results. You might remember last week we talked about ANZ's results. And here's the book, Where Are the Customers' Yachts? This is the book, by the way. You will remember here that the cash profit of ANZ went up. And that's basically because they received more interest on their home loans and they paid out less in deposits. So that was basically the equation. And so for most people, for most investors now, it's basically the same thing. It's saying, well, your profits are up now because interest rates are going up. But I've heard that Joe Bloggs down the road can't afford his mortgage anymore. So what's going to happen? He's with NAB or he's with Westpac or she's with ANZ or whatever. And so now the banks and analysts like myself are looking and we're saying, well, hey, it doesn't actually look that good out if we look 1 to 2 years out into the future. This seems like a pretty good environment to make profits. But what's going to happen in a couple of years? And so we can see here that last year, Westpac had a benefit of 590 million, but this year it had a charge for its impairments of 335. And so if you netted those two things out, you would probably come up with a result that's a lot more compelling. And so this is going to be the key thing as we go forward into the future. This line right here is going to be the very key thing that you should all watch if you own bank shares. I think there was a poll in the live chat there. 66% of people on the call tonight own bank shares. If you haven't already voted, you can vote there. 66%, so 2/3 of everyone on this call own bank shares. And chances are, if you own an ETF, by the way, you own bank shares as well. So I don't own bank shares directly, but my ETF does. So we probably all have some exposure to it. Now, I think Michelle, you said. Like what Owen said, people didn't even know how much they were paying. I wonder if they had written, you give us $100,000, there's a 5% fee, so you give us $5,000 every year. Yeah, so that's the thing. Like the old financial advice, there was very poor disclosure. So you wouldn't even have known if you were paying $5,000 a year in fees. It's crazy. There's still some fees that up until even a year or two ago were still getting paid to by lick fund managers to financial advisors. It's incredible stuff what goes on. But yeah, we went in to talk about that tonight. It's a whole rabbit hole. So this is the key thing that we're going to watch tonight. Now, going forward, sorry. Now, I want to just bring it back to me really quickly, and I want to come back on what I said before about we talk about all this really complicated investing stuff, but the way you value a bank is you just imagine it's like a magic money machine, right? You put your money in as a shareholder and you get some dividends out. That's basically all you've got to think about. What are the dividends that come out? Now, if you want to go a step further, you would be asking yourself, what goes into making a profit? And we just saw some of those things. We've got the fees they collect for the other things that aren't lending. And then we've got the money that they make from lending called net interest income. And we learned that higher interest rates means more income because they can flex their muscles and make a bit more money there. And so what we will see, in my opinion, going forward is we will see more income because interest rates have gone up. I don't think it takes necessarily a rocket scientist to work that out. We will see banks making more income. Now, they'll also be paying more out in term deposits, but the margin that they will make will be wider. So that will mean bigger profits, less what they have to pay out in impairments. So one of the things that I'm looking at the moment, there's no way to know for sure how much bad loans there are going to be in Australia in the next few years. But one of the things that I'm looking at is basically all of the banks that are trying to lend more money when house prices are falling. Those are the banks that I tend to avoid because in times of uncertainty, I want a bank that just lends consistently, whether house prices are going up or whether they're stable. Now, all of the banks have pretty good lending criteria. There's a lot of stuff thrown around about how dangerous things are and whatever, but most of the banks are pretty well regulated. And here's the main point, and this is a kind of a lesson from Warren Buffett, which is that if you have a big, important bank in your economy, so like here in Australia, we've got probably 6 of them. If you have a big, important bank, it can't fail. It can't fail in the sense of if it fails, there's going to be a lot worse than what's going on with your dividend check. And so we saw this in COVID. We saw that the government and the central bank was prepared to step in that quickly when things were scary because they wanted to ensure the banking system held up. The banks took full advantage of that really cheap money that they could use, and they lent a lot of that money straight back into homes and gave people interest-free periods and all this sort of stuff. And that worked out in their favor. And will that happen going forward if things get really bad? Probably not the same way, but you can almost imagine that it would be really important for the government to help the banks out. And we often say there's that, you can say it tongue in cheek, it's not a very nice thing, but you privatize profits and you socialize losses, meaning that when things get really bad, you say, how bad is this? Come help us. We need to make sure all these people still have their bank accounts. And it's very hard politically to say, no, you deal with it, CBA, you go and deal with it. It's your problem. Because if it affects a lot of people. But then when banks are making bigger profits, they don't have to give back those profits. So I guess the thing to keep in mind going forward is I think all of the banks are still going to be making profits. All of the banks are still going to be here in quite a few years. I think fintech has proven that it's probably not going to disrupt it as we thought, at least not the lending side and at least not straight away. So now we've got to talk about, well, how do we value, heads I win, tails you lose, Michelle, that's right. So banks pay enough company tax. Well, that's fair, Chef Circle. Banks do pay, of all the big companies in Australia, banks pay a lot of tax. Look at this line right here, $3 billion. This is one bank. So do banks borrow in USD to lend money? Yes, RBT Cat, they do. They do lend. They do borrow from overseas markets, and that's called a wholesale debt market. And you can see that here from last week. I don't know if they actually break it out separately, but they do. And we talked about this with Kerry last week, that they do, but the banks are pretty well insulated for a lot of it. They're pretty good at refinancing, hedging, and kind of protecting themselves. And you can see it here, like even though they use wholesale funding, they still use a lot of term deposit funding. The bank with the most term deposit funding is CBA. So that's from term deposit funding equals good, guys. If that's all you need to think about, term deposit funding equals good, because it means that the banks have more control over where they get their money from, which they lend out. Now, this definition here is going to sound pretty geeky, but bear with me for a few moments. how to value bank shares. So the dividend discount model, or DDM for short, is a quantitative method used for predicting the price of a company. Okay, I'm going to sleep. Basically, that was from Investopedia. Basically, we can use the dividends of a bank to predict its valuation. And so here, what we can see is the banks, this is from Selfwealth, just if you just go into the financials and you go on the income statement tab, I believe, get rid of these things. And if you go down the bottom, you can see DPS, which stands for dividends per share. You just click on that one right there. And you can see dividends. Who's this from? ANZ. You can see during COVID, they wound back their dividend in a big way. Now, if we bring up the same thing for CBA, let's go with that one. You can see here, get rid of these two. DPS stands for dividends per share, remember? Here you can see CBA's dividend. Obviously, they might have paid a special dividend or something that year, but you can see, for the most part, it's pretty stable. Like, you wouldn't say this is going to be normal, but you might say somewhere around here is going to be an average, right? And so what we can do is we can basically take the dividend and we can divide it by effectively the value of a company. That we can take the dividend and divide it by the risk of that bank and how fast the dividend might grow. So it's very simple arithmetic, and I'll give you an example. I'll see if I can do the maths off the top of my head now that I've said it's very simple. So imagine a dividend of, say, $3.50. You can take that and you can divide it by the growth rate of the dividend minus the risk rate, I think it is, or the risk rate, sorry, minus the dividend. So let's say you have a 10% risk rate and like a 2% growth rate. This 10% risk rating is basically, think of this like what return do I expect from this investment? So if I expect a 10% return, I put 10% in here. What's the 2%? The 2% is how fast do I think it's going to grow? And if we did this really quickly, I'll see if I can get this up in my browser really quick. I love doing maths on air. I always struggle when I do maths on air. Let's go like this. Like this, let's see. And so there we go, it's done. So this effectively says if the bank pays a dividend of 3%, $3.50 per year, and I expect a 10% return, and I think the dividend's going to grow at 2% per year, my valuation is $43.75. Now you can Google, I'm sure you can Google DDM calculator, something like this, and it will come up with a calculator like this one. I've never seen this before, by the way, but you can basically do the same thing. And so here you can see they've done a few more steps in it, but what I've basically said is the case. This is actually, it might seem simple, guys. So this might seem simple, but this is actually the oldest stock valuation model used on Wall Street. So it is still used today. In fact, I still use it for certain things. This is the simplest expression of it. There are more complicated versions. But when we do valuations as investors, what we are effectively looking for is we're effectively looking for a stable income, and we use that to predict what the valuation should be. Now, it's not always the case. Remember, valuation is more art than science, but you get the picture. And remember, it also depends on what your growth rate to be. So let's have a look. Let's use another example. Let's use CBA because, in my opinion, I said I would tell you which were my two favorite banks. And my two favorite banks are CBA and Macquarie Group. Macquarie for growth and CBA because it's kind of the leader in technology. And so if we look here, we can see the analysts have made these target prices, right? We can see that this is what the analysts have said is their valuation. I'll see if I can bring this out a bit. And so we can see the analysts are saying it's worth $94 a share and the current share price is $104. So how do they get to that? Well, basically what they do is they make a bunch of forecasts for the future around profits and around dividends. And you can see here that we've got dividends of $4.29. Let's chuck this into a very simple model. Let's go like this. And we can see we get to $53, right? So you're thinking, well, that's a long way from what they're saying at $94. So the only way for us to think about that is to tinker with it. Maybe a 2% growth rate is too low for CBA because CBA tends to pay, an increasing rate of dividends. So let's say they grow dividends at 3.5%. And if I can do this correctly, why did that go there? Could I do 2 like this? Okay, 0.035, that's what I want. Now we can see the valuation is $66. But let's say one final thing, and this is the thing that gives Australian investors an advantage over international investors in banks. So we know, say in this example, that our valuation is $66. We also know, however, that the dividend that Commonwealth Bank pays is fully franked. It gets you a tax credit that you can collect at the ATO when you do your tax return. Remember franking credits? These are the things that boost your dividends here in Australia. And they're a political thing like you wouldn't believe. And I think they're a great thing because they actually make sense. Fluent, yes, that's right, franking. And so we know that CBA's dividend is fully franked, meaning you get the maximum amount in your tax return. Now, if a dividend is fully franked, I just want to be really simple with this, but if a dividend is fully franked, you can just divide the dividend payment by 0.7. That's how you work out what the after-tax or franking credit adjusted amount is. So now if we take this $6.12 and we stick that in our model up here, let's have a look at what happens. Wow, I did not plan this. This is all on the fly. I swear it's all on the fly. We get exactly $94, right? So we get exactly $94. G'day, Stevie. Welcome to the live, mate. So we can get exactly $94. So here we can see, based on what the analyst was saying, we're probably, to be honest, we're probably using the same inputs and outputs as maybe some of these analysts are using. $94.21. And we got it here, $94.15. So this is basically how we get to it. Now, this is not just good enough. We have to actually look at it. We have to say, okay, the three things that we know. We made a guesstimate of the dividends into the future. No one knows for sure, but we made a guesstimate. We assumed it was going to be fully franked, which it probably will be. We've said we want a 10% expected return. 10% as a decimal is just 0.1. And we've said we expect the dividend to grow at 3.5% per year. And that gets us to a valuation using this old school method of valuation of $94. Now, the analysts that do all these things will have much more complicated spreadsheets. But if we come down, you can see here that some analysts are saying the dividend is going to be $4.70. That's a pretty bold statement. You can see that the median is around $4.28. If we go out another year, you can see the dividend is going to grow again. So you can see basically what it comes down to is what do you think the dividend is going to be going forward? But more importantly, what are you assuming for a return rate and what is your growth rate? Let's say that we assume that no, because the market is very risky at the moment, we want a 12% return, not a 10% return. I think you can guess what's going to happen to my valuation. It's going to fall because if we're saying it's riskier to invest now, the valuation has to come down. So for me, you might be thinking, okay, tell me the answer, Owen. None of this, no more mumbo jumbo finance stuff. What does it mean? It means, to be honest, that banks are probably around about fair value. CBA in particular is probably around about fair value if you can collect the franking credits. If you don't get the franking credits, then it's probably not worth as much to you. But for most Aussies and super funds and all that and retirees, it's definitely good because you get the full benefit of franking credits. And individual Australian tax payers get the benefit of it. And the thing that happens with banks, just so you know, in Australia, is that they rarely become super undervalued. It's rare that they become really undervalued because everyone knows that, yes, your investment return is not guaranteed, but at the same time, you can benefit from basically knowing that the government's going to step in if things get really bad. And so, rule of 72, Mike, Yeah, so Bill, you said mine's in super. Yeah, so if you're in a superannuation fund and you're only paying tax at 15% as opposed to, say, someone outside of super that's just investing straight up, they would pay 30 or 40%. It's a bit different because you get more of the franking credits back to you. And if you're in a retirement phase, it's even better again because you get all of the franking credits back, which is great. So dividends and franking credits in particular should not be overlooked, especially for banks. Now, I said Macquarie Group's my favorite from a growth perspective. And the reason that, and I'll finish with this before we get into the top 5 most bought and sold. The reason that Macquarie is my favorite from a growth perspective is as follows. If we look at the net interest income, remember this is from lending, right? And then we go non-interest income, just like we did before. You can see here, that's a bit of a bad color, but you can see net interest income is, it's really hard to see with this one, but net interest income is right down the bottom here. It's a tiny, tiny, tiny amount. Let's see if I can go down. Tiny, tiny, tiny amount. But if you look at non-interest income, the money that the bank makes from the things that aren't lending, you see that that's really profitable because Macquarie makes more money from investment banking, from overseas infrastructure projects, and all of, like, they call it the millionaire factory. And you can see that there, color selection on the charts. I don't know how to, I don't think I can control it. So I'm going to try hit refresh and see if I can get a new, oh, there we go, I got a new color. All right, let's give it a whirl. Let's see what happens. So net interest, where is it? Where am I? Net interest income, non-interest income, like this. So there you have it. And you can see down the bottom here in the last, say, 5 or so years, Macquarie is starting to offer more traditional style lending. This is something that I've noticed and I've talked about quite a bit. Would the government step in for all banks, e.g. Macquarie, or just the big four? Well, they'd probably step in for all four, Benny. There's a rule in Australia that basically means that the big banks cannot acquire other banks in Australia anymore. I know we've seen a kind of exception with, is it ANZ and what's the name off the top of my head? Can't remember. It's from Queensland, Suncorp, but that's not really a bank. It's more of the banking arm of the insurer. So what would happen, Benny, is probably one of two things. If one of the smaller banks, like Bendigo Bank, that's not it. Bendigo Bank, yeah, Suncorp. Thank you, Chef Circle. Bendigo Bank or BOQ, if one of these failed or was looking pretty bad, what would happen is probably another acquirer would come in and take them out. So it would acquire them, say like an ING, which is the big Dutch bank, or even maybe the government would allow an Australian bank to kind of come in and bail them out. But there is a thing that happens, Benny, just a bit of a nerdy thing. The big banks, because they have that kind of air quotes implicit guarantee, they actually are, there's two things that come with that. One is they have to actually pay a very small fee to the government for that. So there's a very small fee that they pay for effectively the insurance. The second thing is that because they're in that category of too big to fail type thing, which I'm very cautious of saying on air, but because they're in that too big to fail camp, they actually have different methods and different models for assessing their own risk. So they actually are a bit more liberal in what they can do and how they test their own balance sheet. So there are certain rules that come with that kind of government backing, if you like. But that's the basic way to think about it. So you can go away and do this for all the banks. I would just say, don't just take this formula and think, oh, well, I'm just going to put a magical number in here. Garbage in, garbage out. I had a great conversation today with a global investor who said to me that valuation is an opinion. It's not a fact. And that's what I would say. It's valuation, it's opinion, not a fact. So when you look at these things, be sure to look at what dividend assumption you've put in. Also, whether it pays franking credits, the return that you expect, which is also called the discount rate, and the growth rate. I would say when I do my valuations, I mostly look for something with a 3% growth rate like this because it's a bit more stable. BOQ acquired ME Bank. Yeah, that's right, Pima, but that's a bit different. So the reason that BOQ could do it is because BOQ is not considered one of the big four. So they could acquire it. Okay, let's get to it. We have the top 5 bought and sold. And remember, all you've got to do is guess the number 1 most bought and the number 1 most sold, and you will win a Value Investor Program pass, or you could gift that to a friend, and you will receive some free trades with Selfwealth. All you need to do is guess the number 1 most bought and the number 1 most sold. Come on, guys. We need everyone to win before the end of the year. And you just send proof of your YouTube login so we can prove that you are the one that guessed correctly to marketing@selfwealth.com.au. And while you do that, I'll read some comments. B. Caddis says, Governments can bail out banks that are too big to fail, but only one or two. The taxpayers wouldn't let more bailouts to occur. Yeah, that's correct. Jonesy, you've guessed Pilbara for both bought and sold. Jeremy's guessed BHP most bought, LK most sold. Got to win before the end of the year. I thought you'd already won, Jeremy. Mike, Pilbara and Pilbara. I think those are two. Japinder, you've guessed bought Pilbara, sold FMG. Interesting stuff, guys. Interesting stuff. Well, while you get all your guesses in, I'm just going to doodle around here and let's try and find an inspiring investing quote. While you do that, Masters Invest. This is a good website if you want to learn. The gentleman that runs this website is an Australian, and he just reads like you wouldn't believe. And he goes into these books and he tries to find the best quotes and then categorizes them all for you. So let's find a quote under study history. History does not repeat itself, but it does rhyme. Mark Twain. I used that on the show a little while ago. Let's have a look at one thing all of us have learned is never ignore the lessons of history. Paul Tudor Jones. You might be thinking, well, why is Owen showing me this stuff? It's because when the market was really scary a few months ago, you will remember that I did things like this. I showed you the stock market returns over 150 years. I showed you how companies have got profitable over 10 years, not over 10 months. And I showed you all of these things to do with history, because when you're uncertain, you got to remember why the stock market goes up over time. Okay, so it seems like everyone has got their guesses in. ETFs are not included. Sorry, Eve, I just saw your message. ETFs are not included. No to the ETFs. Just shares. Just shares. Never won, Jeremy. I thought you'd won, mate. You should win just by virtue of just rocking up every week for however long and learning and doing all that. Most bought, Eve says BHP, most sold CBA. Okay, I'll give you a couple more seconds and then we'll get into the list. I'll bring up my list on my other tab here and we'll go 5, 4, 3, 2, 1. No more bets is what I'm going to put in there. Just like at the casino, they say no more bets on the roulette table. Don't worry, I don't go there that often. So, okay, I see Stevie, you got in just in time. No worries. Okay, so here we go. In at numero 5, we'll go through the buy list. So on the buy list, in at number 5, we've got Core Lithium, this old one. I think I can't remember who it was, Jeremy or someone said earlier on. Mike, was it? One of you said that, or Jason. You listened to the Australian Investors podcast recently where I interviewed Luke Larrative. He went through all of the lithium mining companies and why he likes some of them, why he doesn't. Core Lithium was on that list. Lake Resources in at number 4 on the most bought list. In at number 3, another lithium player, and the final lithium player on the list for the buyers is Pilbara. Sorry, guys, if you did guess this as number 1. It is number 3 on the most bought list. In at number 2, this is going to break some hearts as well, BHP in at number 2. Number 2 in at number 1 on the buys. I don't know if I saw this name appear too often. Is Fortescue Metals Group in at number 1 on the buy. So just in reverse order, 5 was Core Lithium, 4 was Lake Resources, 3 was Pilbara or Pilbara, we don't know yet. 2 was BHP and 1 was Fortescue. Over onto the sell list. This company has been appearing a lot. Tesla, following Elon Musk's purchase of Twitter. Maybe he trades through Selfwealth. I can neither confirm nor deny, but maybe, just maybe he does. And he's the big whale in the group that's constantly selling or buying. Who knows? Pilbara in at number 4 on the sold list. In at number 3 on the sold list is Lake Resources. Have a guess what? In at number 2, we've got BHP. And in at number 1, we've got Fortescue. So what that means is Fortescue was number 1 on both lists and BHP was number 2 on both lists. So in reverse order for the sells, we've got Tesla, Pilbara, Lake, BHP, and Fortescue. Did anyone get them correct? Please tell us. Please tell us. Did you? Stuart says it's Pilbara, as you said it the first time, not Pilbara. Stu, I'm going to have to get you to figure this out for me. So it's Pilbara? Pilbara, is it? Or Pilbara? What do you think? Pilbara says Owen. Owen, okay, I'll tell you what, now that Owen, you've said it, Pilbara, I'll go with that from now on, mate. Such a good name. I agree with you. Okay, so Stu, you know it's all tongue in cheek. Pilbara. So it's like a pill with bra on the end. Pilbara. Okay, got it. Nice. Peter, you said great learning today. Lots of in-depth stuff. Well, I'm glad you enjoyed it. Well, I've already given you. This is the same one as last week, but I think it's a great one. You can go to Masters Invest, which is where I get a lot of my quotes from. It's a fantastic website. Have you subscribed yet? If you haven't subscribed yet, Rob and I are probably going to go after this, and we're probably just going to cry until next Wednesday. So if you haven't already subscribed, please save us the tears. We don't want to be that dehydrated. Please subscribe to Selfwealth on YouTube. And always check your emails from Selfwealth, by the way, because you will see features and things that are released. You'll see them via email. There's alerts that go out and so on and so forth. Also, don't forget to check out Big Swinging Stocks. It's in Spotify. It's on Apple. It's wherever you get your podcast. It will be there, just watching you and waiting to be listened to. That's Big Swinging Stocks, the Selfwealth podcast. You can get that on all of your favorite channels. Glad you all enjoyed the session. What do you want me to talk about before the end of the year? I've got a few really good ideas. Peelbra is another way to pronounce it, apparently. Peel, like peel an orange. Interesting. Let us know. Owen, you missed it earlier, but do ETFs pay franking credits? Correct, Jeremy. They do pay franking credits, so you can say it. You can say that they definitely do. Like obviously the Aussie ones, you don't invest in the S&P 500 ETF expecting to get dividends, but listed investment companies pay dividend franking credits as well. Ramnik, well done, Owen. Thanks, mate. Thank you. Oh, interesting. Yeah, Selfwealth. Rob, you're saying there was an episode out recently on Big Swinging Stocks where Alex, the host of the Selfwealth podcast, talks about her net wealth, which is a pretty revealing thing to do for a lot of people in the public domain. But hey, she's doing it. All power to it. Pete, she said, you made the mistake of starting the stream after the stimulus boom, not before. I know. What is going on here? Deep dive into a US stock, says Stevie. What kind of US stock do you want, mate? Let me know. Remember, you can find us #Selfwealth Live, and everything that you hear tonight, of course, is limited to general financial advice only. We do not know your personal circumstances, particularly when it comes to bank shares and stuff. I think it's important that you take your time. And a big reason that a lot of investors don't talk about valuation, there are two reasons. One is they don't want you to see how simple it is. But two, the second reason is it's risky to come on air and say, you can use this valuation theory and you can do this. It can be quite risky. It's like, if you hand a hammer to your brother-in-law who's never picked up a hammer in his life, and you say, go and repair the bathroom for me, would you? It can be risky. You got to know how to use the tools. So be sure to take your time. Can we review our two portfolios and how they have gone with interest rate changes, inflation? Absolutely. I think, JJ, that's awesome. We will do that. I've been saying we're going to do that for a few weeks. I know that Okta has been sold down heavily. I need to adjust the share split for BHP. No one got Fortescue, says Jenny. No one got it. Okay. Well, if, I don't know what else we can offer you, but Jeremy says Scott Galloway on top US staples companies, Amazon, Alphabet, so Amazon, Apple, Google, Microsoft, the ones that tall order. Would you cover Redbubble? Yeah, I can cover Redbubble. That's one that I know well. We can do that in a few weeks. We can even just do a short segment on that. Chelsea said, can you talk about how ETFs are structured regarding to price, underlying asset or bought and sold price? Yeah, I can answer that really quick, Chelsea. An ETF share price is basically as close as it gets to the value of everything that's inside it. There are times when they separate, but it's pretty rare. That tends to happen in like a market crash or something like that. For most share ETFs, it's very close. The value of whatever's inside the ETF is typically very close to the actual share price that you see. B Caddis, big call here. Lithium stocks the next crash when the global recession hits. Stevie, Amazon, their AWS cloud versus their marketplace. Stevie, we can get to that in a few weeks, but one of the things that you should go away and Google while you're on the topic is Google Amazon versus Cloudflare. Amazon versus Cloudflare. That's a good debate. The two companies bashing heads over a few things. Go and check it out. Cloudflare versus Amazon. So last question I'll answer for tonight before I got to run down to this event. Jeremy, Owen, how are you feeling about Tesla post Elon's Twitter purchase? I'm actually going to do a deep dive into Tesla before the end of the year, so I'm happy to share an updated, idea around that with you. I think, to be honest, I think Tesla's big enough now that it doesn't rely on any one man or any one person. I think that he's still heavily, obviously, involved in the business. He didn't found the business, by the way. He's just he's perceived as the founder, but it's not the case. I think, to be honest, I can only speculate about how he's feeling about Twitter more than I can about Tesla. But I think Tesla's a much better business than Twitter is. What's everyone's opinion on Navati? Well, Flippy, I did look at it and I didn't like what I saw on first glance, but it proved me wrong. So that's what my 2 cents is worth. Okay. So yes, I just bought it and took the credit. Okay. So there's so many good questions. Ethan, I can see you asked a question about Volkswagen and Tesla. The thing that you just mentioned about Volkswagen and BMW and all the others producing more electric cars, like Renault producing more electric cars than Tesla, is a very real threat. But you got to remember, Tesla's coming in at the more premium end of the market and has better performance metrics across almost everything. So, yeah, guys, thank you for tonight. I've got to run, and I will see you next week. Rob will see you next week. Virtually, we'll be back at 6 p.m. next week. We'll have Nathan Bell. Remember, he's the ASX expert. So please come loaded with good questions around valuation, go and check out the Intelligent Investor website. Look at the companies that are on their website and what they've invested in. Go and check it out, and then come back and ask questions on those companies. I think that's the best way to do it. Okay, guys, thank you so much. On behalf of Rob and I, on behalf of Selfwealth Live, thank you for tuning in tonight. We always really appreciate it. Tell your friends, share these things with them. Share that 50 grand one with them, the one we did a few weeks ago, where I would invest 50 grand. It's really punchy. It'll cut through the noise for them, and it'll help them invest better. Thank you, everyone.